The market for Eos Energy Enterprises, Inc., trading under the ticker EOSE, is closed as of November 7, 2025, with a last closing price of $14.58 on Nasdaq. The stock experienced an intraday movement on that final session, closing down by 70 cents, which represented a minus 4.57% decline from the previous close. Now, the immediate reality that should supersede simple price movement is not the minor daily pullback, but the context it happened in. A post-earnings reaction where a massive $644.4 million backlog and record quarterly revenue of $30.5 million were overshadowed by a significant, albeit mostly non-cash, net loss of over $641 million and a revenue miss against analyst expectations. Most investors, especially those who rely on quick headlines or the most accessible data on investing sites like Robinhood, saw the revenue miss and the large loss number and hit the sell button, creating that dip. The curiosity loop, the angle you might not have anticipated, is that the colossal net loss figure is largely due to mark-to-market adjustments on convertible notes driven by the massive increase in the stock price over the last year. That's right. The stock's prior impressive ascent is indirectly what magnified the reported loss, creating a financial headline that looks terrible but stems from a positive stock movement. This tension between paper accounting and physical operations is the core of the EOSE narrative right now, and it's something that often gets lost in the noise of individual brokerage trading. The general belief, particularly among the retail cohort who are actively engaged in self-investing, is that Eos Energy is a high-beta, high-risk, high-reward bet on the domestic energy storage build-out, an alternative to the dominant lithium-ion chemistry. They see the zinc-based Zenith battery technology, the large order backlog, and the push for U.S.-based manufacturing, all legitimate growth vectors, and they anticipate a steep Tesla stock-like climb once the company successfully executes on its orders and achieves true manufacturing scale. The expectation is simple. Massive orders translate to massive revenue, which should translate directly to a consistently higher share price. However, the deeper reality, which the smart friend over coffee would point out, is that Eos Energy is squarely in the most difficult phase of any hardware scale-up, the transition from proof of concept to profitable mass production. The recent quarter's results reflect this perfectly. Yes, revenue doubled sequentially to a record $30.5 million, a massive leap from the year-ago quarter, driven by the ramp of the Z3 system. But the gross loss for the quarter was an alarming minus $33.9 million, a testament to the immense upfront cost associated with bringing automated sub-assembly lines online at their Turtle Creek facility and smoothing out the kinks in a brand new supply chain for a unique product. The cost of goods sold is simply outpacing revenue by a significant margin as they absorb all those startup and scaling expenses. This is why you see a consensus hold rating with an average price target that's actually below the recent closing price, despite a couple of analysts from firms like Stifel and Guggenheim having very bullish buy ratings and high targets. This divergence in analyst opinion reflects the fundamental disagreement on one point. Can Eos Energy achieve the cost curve reduction and manufacturing efficiency necessary to turn gross losses into gross profit before running out of capital? That is the reality that challenges the expectation. Let's look at the recent stock movement. The 4.57 drop on Friday was a direct consequence of the earnings report, but it followed a period of intense volatility and a significant upward trend since hitting its 52-week low of $2.06. The stock has been a speculative magnet, trading near its 52-week high of $19.05 just before the report. Trading volume remains relatively high, often exceeding 20 million shares, indicating a mix of high-frequency trading, day traders looking for swings, and genuine institutional interest. The chart action over the past 6 months shows massive institutional accumulation, particularly in the second quarter. Big players like BlackRock, Vanguard Group, and UBS Group AG have dramatically increased their positions, often by hundreds of percent. For an individual investor managing their own portfolio on a platform like Fidelity or utilizing Schwab Intelligent Portfolios, this institutional activity is critical to note. It suggests that large, sophisticated investors are buying into the long-term supply and demand theme for American-made non-lithium energy storage. They are looking past the current negative profitability metrics and focusing on the total value of the $644 million backlog and the $22.6 billion commercial opportunity pipeline. However, we also saw insider selling from officers and directors over the last few months, a common but always cautionary signal that needs to be weighed against the bullish institutional inflows. The company's core business is the design, manufacture, and deployment of its Eos Zenith aqueous zinc battery storage systems for the utility, industrial, and commercial markets. Unlike Apple stock or Nvidia stock, whose products are largely mature and profitable, EOSE is in a capital-intensive manufacturing business, selling to a utility sector that operates on long lead times and high certainty. Their Zenith battery offers a couple of distinct advantages. It's inherently safer than lithium-ion. It uses readily available and non-flammable materials, zinc and water, and it's designed for longer duration discharge, 3 to 12 hours, which is a crucial capability for grid stability as more intermittent renewables like solar and wind come online. The business model is focused on scaling up production at their Turtle Creek facility in Pennsylvania, moving from the current 2 gigawatt-hours annual capacity to what they project could be 8 gigawatt-hours down the line. Recent large-scale orders like the 228 megawatt-hour deal with Frontier Power and the 750 megawatt-hour master supply agreement with MN8 Energy confirmed that customer demand for this non-lithium option is real and massive. The immediate daily swings are reacting to the short-term financial pain. The Q3 earnings report highlighted a $52.7 million adjusted EBITDA loss, which is relatively flat with the prior quarter, but still indicates that the company is burning cash at a steady, significant rate as it scales up. This financial reality, coupled with a recent short seller report that raised concerns about financial transparency and technology safety, concerns the company pushed back against, has put downward pressure on the stock when results are mixed. For anyone participating in online investing, particularly through platforms like SoFi Invest or Interactive Brokers, where information asymmetry can be high, it's essential to understand that Eos Energy is a story stock, but one where the story's execution is still highly dependent on operational improvements and capital management. The company successfully closed concurrent offerings of common stock and convertible senior notes earlier this year, raising $336 million, which provides a crucial cash cushion of $126.8 million as of the last report. That capital is the oxygen the business needs to survive this scaling phase. Looking ahead, the future outlook for Eos Energy boils down to 3 core catalysts and 1 major risk. The first catalyst is the successful automation and full ramp-up of the Turtle Creek manufacturing facility. They expect to triple Q4 output, and achieving that volume with improved cost per unit is the single most important factor. If they can show margin improvement in Q4, that would be a clear sign that reality is meeting the market's high expectation for operational efficiency. The second catalyst is continued momentum from government support, specifically the tax credits available under the Inflation Reduction Act for domestically manufactured battery components, which significantly enhance the economics of their product against foreign competitors. This is a powerful, non-company-specific tailwind. The third catalyst is the strategic partnerships, such as the collaboration with Talon Energy to support data center and AI infrastructure power needs, a powerful and timely market vector that most people associate only with Nvidia stock. The convergence of energy storage and AI data centers is a niche that could provide an explosive new source of high-margin demand. The major risk and the counter-narrative to the bullish view is capital and dilution. The negative free cash flow is substantial, and the company's ability to meet all its projected manufacturing goals and operational milestones is critical for accessing the remaining tranches of financing from its partners and the Department of Energy's loan facility. If they miss targets or burn cash faster than expected, further equity raises and subsequent shareholder dilution become a very real possibility, which would depress the stock price regardless of the growth in their backlog. This is a common pitfall for hardware companies in hyper-growth mode. Whether you use a full-service platform like Fidelity Wealth Management or a self-directed tool like the Fidelity mobile app, the due diligence here focuses less on stable earnings and more on operational expenditure and financing. The current tension is this: the market expects EOSE to become a key infrastructure provider in the multi-billion-dollar clean energy transition, validating its premium valuation. But the reality is a manufacturing company